So Antoine Rempp with Executor Expert, and we have Gavin here with BDO. So he's a tax accountant and he works a lot with farmers and estate planning. So what we're going to talk about today is the amount of tax returns that you can expect filing. So how many, what are the main ones that you can expect filing if you're now handling an estate for someone?
Sure, Antoine. So there's really only one required tax return. You have to do the final return for the year that the person passes away. But there are up to 5 returns that you can file in the year of passing. In order, there's of course the final return for the deceased. There's a trust return, if necessary, for the estate of the deceased. Your will basically creates a trust that your executor is administering. So that trust needs to file a tax return if the trust has income. If the assets all go straight to the beneficiaries, you may not need it, but most of the time, more often than not, we do need at least one trust return just to deal with the remaining income for the year and a few other items that pop up. Then there's a return for rights or things, which really only comes into effect if you have something that was due to you when you passed. For farmers, this can include farm inventory. For anyone else, it's usually receivables, a dividend that had been declared but hadn't been paid out yet, or other items that are due to you. There's 2 other trust returns that can be filed. One return is a return for professionals that have chosen an off-calendar year end. Okay. Those are quite rare these days. And the last one is a return if your estate is the beneficiary of another trust. You can file a separate return for that. Okay. Now the primary reason you file these multiple returns, one is if you fall into the categories where you have to, but primarily it gives you an extra set of tax rates, and there can actually be quite significant tax savings if you can spread your income and report it on several returns instead of one.
Okay. So what is the time frame that you're supposed to file those returns?
Sure. The final return for the date of death is due April 30th, or the same time your normal return would be due. So if you're self-employed, June 15th, normally April 30th. If you pass away in the very end of the year, in November or December, you always get 6 months to file. So they'll give you an extension for that terminal return. The first return for the estate will be due, basically you can pick a year end for that return any day up to a year from death. And the return is due 90 days after your year end. So sometimes we'll choose December 31st just to keep things simple and on the same calendar basis. But if you have somebody that passes away later in the year and they need a couple of months just to get things figured out and sorted out, and then they can just distribute the assets and be done, perhaps we'll do an estate return for, say, 6 or 8 months and then choose that as the year end, file, and clear it up. Once in a while, you do have estates that go on for several years. You might have clauses in your will that require that you hold assets on behalf of minor beneficiaries or other beneficiaries for 3 years, 5 years, until they reach a certain age, until they do something in particular. I've seen wills that say, they don't get their money until they get their first degree. Yeah. You can say whatever you like in your will, and that might create additional filings where you have to file estate returns on an annual basis until the assets can be distributed.
Interesting. So you want to, the executor is in charge of doing those returns, right?
It is the executor that is in charge of filing returns. Whoever the trustee is, and in the context of an estate, your executor is the trustee of the trust.
And there's one more return that has to be filed by the executor if the executor is going to receive compensation. Is that right? How does that work?
Not quite a return. What it is that if the executor takes compensation, the executor is basically treated as an employee of the estate. Okay. The estate has to create a business number, a payroll number, has to remit taxes and potentially Canada Pension Plan premiums. Yeah. And file T4 slips and report the income that the executor has to report on their return. If as an executor you take compensation, it is taxable to the executor. Okay. And that can take a big whack out of that compensation.
That's right. And that's why it's so important if you're going to end up dealing with an estate, so before the person passes or after, to have the accountant on your side to make sure that this is done right. Because if you screw it up and you end up not paying enough taxes, who's going to be liable for that?
Well, exactly. If it gets messed up, there's usually provisions in the Estates Act and in the Wills and Estates Act in Alberta that say that the executor is held mostly free and clear as long as they've done their due diligence. So the estate will pay the bills as long as the executor's done everything they can to try and ensure they've met their filing obligations. if you're careless in how you handle your obligations, the executor can personally be on the hook for some of those interest and penalties and so forth. Penalties for not filing a T4 slip can be $2,500.
Yikes. Yeah. So thank you. So that's good to know again, and importance of having an accountant on your side to get you through that process. You can't avoid that. You had to work with an accountant. That's what I feel.
Oddly enough, I feel the same way, Antoine.
That's right. Thank you.